The opinions expressed on this program represent the viewpoints of individual authors or contributors and do not necessarily reflect those of Troy University.
Hello and welcome to EconVersations. I'm your host, Dr. Dan Sutter of the Johnson Center for Political Economy at Troy University. If you totaled your car, if your house was struck by lightning and burned to the ground, or if you suffered cancer, you could face financial ruin, even if you avoided injury or fully recovered. If a community is devastated by a tornado or a wildfire, it'll need resources to help rebuild. If the income earner of a family suddenly dies unexpectedly, who's going to pay their bills? In all of these cases, the answer is often insurance. Insurance is a product we all buy, often never want to have to use, and which also seems kind of boring. And yet it represents one of the cornerstones of a modern economy. And when you dig into it, insurance provides an alternative to charity and government regulation in some important and unexpected ways. It does this all voluntarily and contractually, which is pretty amazing if you really think about it and get into it. And that's what we're going to do today. So joining me today to talk about some of the hidden wonders of insurance is Dr. Courtney Baggett, an assistant professor at the Sorrell College of Business. Courtney joined the Troy faculty in 2017 after she had earned a PhD in insurance at Florida State University. Welcome to EconVersations, Courtney.
Thank you.
So first, before we get started, why don't you tell us a little bit about yourself, because you started your academic career here at Troy, right?
Right. So I came to Troy for my undergraduate work, and while I was here, I interned 3 times with different companies in different areas of insurance. I also worked for a few years as an independent agent, so I sold property casualty products, mostly to contractors. And then I decided to go to Florida State to get my PhD, and after I finished that program, I actually was on faculty at Butler University for risk management and insurance as well before I was asked to join Troy again, or was presented with the opportunity to get back to Troy.
So as a discipline when you're studying, like it's often called risk management and insurance, and so like, what exactly are you studying? What's your area of study here?
Yeah, so a common joke among insurance academics is that they don't know a whole lot about insurance. I actually know a little bit more than most about the granular pieces of insurance because I worked as an agent, but that didn't come from my formal graduate program. So when I started my PhD program, someone that was ahead of me in the program sort of explained it as, we're just applied economists. We really just study the insurance market, and we study the topics that that people in finance or in econ study with a general group of firms. We just happen to study those topics within the insurance industry. So things like profitability and competition are topics that are studied commonly. So I would say it was more of a market study of insurance, or an operational view of the insurance industry, as opposed to a really granular view of what's going on within an individual insurance company.
Okay, so we talk about some of the reasons we might have to have insurance and some of the disasters that might befall people. So this would be to some extent what the different insurance companies are covering, right?
Absolutely. And we generally segment the insurance industry into 2 groups, either property liability companies or life and health insurers. So within a property liability company, they will offer things like auto and home insurance, which we're all pretty familiar with. They'll also offer commercial products. It could be commercial property, it could be inland marine to cover equipment that's used within the company. It could also be things like crop insurance. So there's a wide variety of products there. And then if we look at the other group of life and health companies, we're seeing products like disability insurance, long-term care insurance, annuities, and your basic life and health products.
Okay, and how big is this industry or sector of our economy?
It's probably, I would say we're around 6,000 total companies in the U.S. And again, we can segment that a lot of different ways, but when we look at the premiums that are being written, if we look at property casualty versus those other companies, it's split about 50-50. So they write pretty much a proportional share as opposed to the other group. So I would say that there are about 2,500 of these 6,000 companies are going to be property casualty. And then you're looking at just under 1,000 for health companies and just under 1,000 for those companies that write life and annuity products.
Okay. And so the 2.6 million jobs,
Right.
It's not, a lot of times people think like jobs, having more people employed is a good thing, but these
Right.
people are employed doing jobs that are very valuable for
Right.
for our economy.
And could also be very different. So there are many different ways which an insurance product could be sold. It could be sold, directly from the insurance company, and then some of these jobs are also, intermediary positions where I'm acting as a broker or an agent to help connect the actual insured with the insurance company.
Okay. And then another element of this is the $5.5 trillion invested. I mean, insurance companies control large amounts of assets that they're investing in the economy. The companies that are eventually going to pay out life insurance benefits or so forth, they have huge amounts of capital at their disposal, right?
Absolutely. And you'll see a difference in the way in which these companies invest based on which of those two camps they fall in. Because if we're talking about a life insurance policy, a whole life policy, to be specific, you're going to be my customer until you die. So that's a product that has a very long tail of investment opportunity. I don't have to worry about me paying out that policy tomorrow. Whereas if I'm writing your auto insurance, you could get into an accident tomorrow and I could have to make that payment. So life insurance companies typically are more open to making long-term investments, whereas property liability companies want to keep those investments more short-term because they may have to pay out sooner.
And you talk about this, some of the different elements or segments of the insurance market, and there are different companies that dominate or the largest companies in these different sectors of the market, right?
Right. And so here we have, let's see, it looks like life and annuity companies, which is common. The companies who write life and annuities are usually grouped together. And then we have those who write just health insurance, and then our property casualty companies. And what we're seeing, relatively recently is, a lot of M&A activity within the health market. So, so that market is becoming a bit more concentrated than something like the property casualty market.
And we also have seen, I think, over the last 20 years, a decent amount of banks offering insurance products, and then also some of the health, especially I think the life and annuity companies offering things that look more like banking services, right?
Absolutely. So now we're seeing, insurance, investments, and banking all crossing into one another. And so you can walk into the bank and buy insurance, and you can, buy an investment product from an insurance company.
So we talked about how if in some ways, if I led off the show talking about the example of if a tornado hits a town and devastates the town, that town is going to need resources to rebuild. And we might think that they're going to have to rely on charity or they'll have to rely on government disaster relief. But if we think about what insurance companies are doing, they are really sort of providing the same type of service, right?
Absolutely. And this is a timely topic given the catastrophe activity we've had in the last year, where we've seen communities that experienced a lot of devastation with Harvey or Irma or Maria. But this is really a way that that individuals can be self-reliant in making sure that in the event their house burns down, they aren't left with nothing. They're not, trying to set up GoFundMe pages or relying on potential donors to a charity. They know with 100% certainty that if they have a loss and it is covered, that they're going to be paid. So a lot of this, from my perspective at least, what insurance gives me is peace of mind. How that small premium payment relative to the potential check I get if my house burns down is well worth me knowing that if something happens, I'm going to be covered, and I don't have to rely on the goodness of someone's heart to help me rebuild my home.
And if you were unfortunate, the people who are unfortunate enough to have, like, say, their house burned down, they're going to get a check, or they're going to get their house paid for, the value of their home paid for, or perhaps the value of their car. And that payment that they get from the insurance company is going to be a lot bigger than all of the premiums that they've probably ever written, that they've ever had to pay for that house. So it might look like they are receiving charity, but there's a very important difference here that between charity and what insurance companies are doing, right?
Right. So, an easy way to think of this is that with charity, one can't be forced to make a payment. I can't be forced to donate to a charity, but with insurance, it's a contract. And so if you're the insurance company and you've issued me a contract and I've done what I'm supposed to do and I've made these payments, then if I have a loss and it's covered in my contract, you can be forced to pay if it should get to that point, which it typically does not, because the companies know that if they have a loss that's covered, then they pay that loss. So I guess that would be an easy way to distinguish between charity and insurance. You actually are paying. You're not paying near as much as what the policy is potentially worth. But you also have people, on the other hand, that pay for insurance for 40 or 50 years on their house, and they never have one claim. So it balances out.
And yeah, so I mean, I think that's a really important point. I mean, people aren't receiving charity when they get a big payoff, and it is also, as you suggested, I mean, it's we often use the term sustainable, but and it's somewhat defined a little ambiguously or not clear what it is, but. We don't have to rely on whether people are going to run out of the kindness of their hearts or not, or have some kind of charity fatigue and not giving money to help out the victims of the next disaster. I mean, insurance companies are there and they're willing to do this because, I mean, it is a business. They are going to, hopefully, if they run their operations right, they might be able to make some profit offering insurance and providing the communities that get struck by tornadoes or other disasters the resources they need, right?
Yeah, and if you think about it too, one factor is, well, what if my house burns down and no one donates? I don't get any charity. But also the time lag between a large catastrophe that affects many homeowners within one community and actually receiving that charitable donation. You may have organizations in the area that are getting a lot of donations, but there are a lot of people who need help. And so you're going to have to wait quite a while until you can rebuild that house. Whereas with insurance, you get your check very quickly after you have a loss. I mean, you can go ahead and start rebuilding. And
it's an element of personal responsibility as well. If you're not relying on government assistance or charity, you are making payments that, yes, they might be small compared to the amount of the payoff you get, but because the insurance company is willing to accept it, you truly are, in some sense, paying for that.
Yeah,
the coverage that you're getting.
Yes.
So insurance companies are going to pay these losses when they happen, so they have to have money. They have to get money from their customers to pay for that. They also have like these 2.6 million employees that presumably they all have to earn salaries, and they're going to have other forms of paperwork and other administrative costs that will be involved there. So how is it that these contracts end up making sense for people? Why is it people enter into these contracts, and how is it that insurance is actually like creating value in the economy?
I think that one thing to recognize is that these insurance companies have been doing this for a while, and they have a lot of data to go off of. So, insurance companies will look at these loss trends, and they have a very good idea of what someone is going to cost me to insure them. They're not trying to make a huge profit off of one policy, but they're writing very large numbers of policies, and most people don't want the uncertainty of, well, what happens if my house burns down and I don't have insurance, right? Most people don't want to have to wonder whether or not they're going to get, some type of charitable donation. So for most of us, we are risk averse, and we don't like that uncertainty that's associated with not having insurance and then potentially having a loss. So the value for us comes from paying an incremental premium and knowing that if I have a loss, I'm covered. So that certainty is the value that I think we as a society get from insurance.
And it's what makes people willing to buy, willing to pay those premiums, right?
Absolutely, yeah.
For all of these different types of losses that they might have. Another thing you hinted at that insurance companies are going to do is it has a fancy name, but risk pooling. And so explain to us what this means and why this makes an insurance company willing to write a whole bunch of policies.
Right, so risk pooling really just means that as the insurance company, I'm going to group similar exposures together. And that may be, I may be talking about homes, or I could be talking about cars. Right? I'm not looking for identical exposures, right? It doesn't really matter if it's a red car or a blue car, or if it's a truck versus a sedan, but I want them to be similar enough that they have the same risk characteristics. And if I can group a large number of those together, then I become much better at predicting what my losses are going to be. So this risk pooling is really what allows insurance companies to be financially successful in pricing insurance policies. And of course, the more years they're writing policies, they also have this historical data to lean on as they're forecasting future prices.
Yeah, some cars are going to wreck every year if you write a bunch of policies, but not every car is going to wreck every year, and that's what's allowing you to not have to charge the full value of the car on each of these policies that you're writing, right?
Right, and when we're looking at characteristics of an ideally insurable risk, we want exposures that are similar, but we don't want the exposures to be catastrophic in nature. So all of these cars potentially are being parked at different houses. The chances of all of these cars that we can see on the PowerPoint being damaged at one time is extremely unlikely.
Right.
But an insurance company is going to write a lot more vehicles than we can see on that one expressway.
Yeah.
Right. So they're making sure that their risks are spread out.
And so that makes them more willing to sort of bear this risk than like you or I would be willing to.
Right. Yeah.
Now, you said that the field of insurance is applied economics, and in economics we talk about some of the challenges, but like insurance companies face some really major economic challenges in order to try to stay in business. They have some real problems they have to address, and we're going to talk about three of them. I'll throw out their names here, and then we'll get to each of them. Moral hazard, adverse selection, and then correlated risk. All sound like fancy topics. And certainly both in economics or insurance, we have to cover those topics, and for students in a way that's quite advanced or quite intricate. But let's talk about each of these and what they mean sort of from a practical level. We won't go into any kind of details, but to give you a sense of running an insurance company is a pretty hard job, right?
Right. Okay, so the first one is moral hazard, and that is really just a conscious change in someone's behavior surrounding an event. And this event in insurance is obviously securing an insurance policy. So an extreme example of moral hazard would be someone submitting an application for insurance, and as the underwriter, you're digging through this application to try to figure out information about this applicant, and of course you don't have as much information as they have about themselves. So you may not know that they're having a lot of financial trouble with the business right now or personally. And if they secure that insurance policy, then maybe they commit arson. So all insurance fraud really is housed under moral hazard.
Right.
But then we have less extreme examples, like people building their houses on the coast. That is taking additional risk. You are significantly more likely to experience damage from a hurricane if you put your house right beside the ocean. As someone who lives inland, another example of this could be someone who.
I think like, the change in attitudes, I think, is often reflected when you're driving a rented car as opposed to your own car. You're not quite as careful about it. The point being that you don't bear the full cost of damage to that rental car. Yes, you may have a damage waiver and everything, but it's not
It's
like
just
you're.
not the same, right?
It's not as like it's your car.
Yeah, and it could even be.
And it's often kind of subtle
Right.
in ways, but it does change things.
Yeah, certainly. It may not be as extreme as insurance fraud, but it could be, now that I have, health insurance, I'm going to do all those things that I wouldn't do before, because before I didn't want to bear all of that cost of having to go to the doctor. If I broke my arm while I was, riding a mountain bike or something, but now I have insurance, and
Right.
so I can do those things. And so that shift in behavior is really what moral hazard focuses on.
Another thing that's, in theory, students will learn that they're pretty closely related, but there's also a problem known as adverse selection, right?
Which is, it's a huge issue within insurance, something that we're especially concerned about. And this is a great example on the slide. So when health reform was really put in place, the idea was if we have a pool, if we can make a pool that's large enough, and we have some people in the pool who are unhealthy and maybe a lot older, but we have others in the pool who are quite young and very healthy, then just like when we were talking about risk pooling with the cars, those costs can offset one another, and then we can get everyone insured, and that was really the goal of the Affordable Care Act. The problem is that adverse selection really talks about people who have a higher than average tendency for loss, trying to get average prices or average coverage. So a really good example of this is when you start work and your employer starts paying for your insurance, or paying the majority of your insurance. That is quite different from having to buy insurance directly. For
Right.
example, if you own your own business, it's significantly more expensive for you. And so many people take jobs not for the salary, but because of the great benefits that are offered. And when you're offered this health insurance, you may be comparing 3 different plans, and there's not that much of a price difference in those plans, so most of us pick the most expensive one because it's still not all that expensive, and we want as much coverage as we can get.
Right.
That is adverse selection, and when it happens, we say that the insurance company has been adversely selected against. If someone is able to slip through the cracks, and underwriting is our defense to adverse selection. That is, the insurance company's employees trying to look through that application and see if we really want to offer this person insurance, or what price we want to charge them. That is underwriting, or unhealthier people buying policies that offer more coverage relative to younger, more healthy people foregoing insurance or buying something similar to a major medical policy.
And then the third challenge that it faces for some types of losses, something known as correlated risk, but there's an easier way to think about what this correlated risk happens to be, right?
Right. So if we think, just in the past year, we had Harvey, we had Irma, Maria. We had a lot of earthquakes, earthquake damage in Mexico. We've seen a lot of wildfire activity in California. So all of these are natural disasters or catastrophes that impact a lot of people who live relatively close together. So insurance companies are nervous about these types of events because, for example, if I'm riding all of those cars, Well, the chances of them all being in an accident while they're driving is pretty slim, but if a hurricane comes through, a lot of those cars,
tsunami,
right, a lot of those cars
the tsunami could wash them all away.
Maybe damaged, or the houses. So in other situations, maybe where I feel like I have a pretty good defense, and these cars or these houses are far enough apart that they're not all going to burn at the same time. Well, that's different if we're talking about a tsunami or a wildfire that impacts a huge region at one time. So insurance companies can do a couple of things to diversify away from this risk. With natural disasters, we can diversify geographically. So they don't write all of their business in one zip code, and they don't write everything on the coast. They also want some inland business to balance out that coastal business. And then within particular lines of insurance, insurance companies don't write just one line.
Right.
They'll write different lines so that if medical malpractice takes a really big hit this year, hopefully it is offset by commercial property or something like that.
But if an insurance company doesn't manage their affairs properly, they could go bankrupt.
Right.
And this is particularly problematic because if you or I are assuming or thinking that we're paying our house, paying for our homeowner's insurance every month and to have the coverage if we need it, if the insurance company goes bankrupt when we need the money, or if it was like some kind of a fraudulent scheme set up with no real intention of paying out paying out on policies, then that really disrupts our plans, right?
Right, and it would be a huge concern, but we do a lot of things to mitigate this type of risk. So if you think about starting your own business, whether it's a t-shirt shop or you want to sell ice cream, no one tells you how much money you have to have before you can start operating, whereas with insurance companies they do. So the insurance industry is heavily regulated. For example, we have capital and surplus requirements for insurance companies, so they have to show the state that they have a certain amount of capital sitting there when they start operating. They also have to actively add to their loss reserves, so that shows up on the liability side of the balance sheet. And when I write a policy, I am taking some of that premium that you give me and I'm setting it to the side to be used to pay losses. We also have guarantee funds in every state, and these are funds that are meant to cover insureds who have losses and whose insurance companies go bankrupt or become insolvent.
Now, what we've talked about so far is pretty much like shifting or transferring a risk, but as you've mentioned, like insurance companies know a lot about losses, and they actually are very important, and they are sort of like our first line of defense in trying to reduce losses. And they do that by requiring their policyholders to take certain preventive actions, right?
Right, so it could be something like a business being required to install security cameras or install a sprinkler system, which is especially effective when we're talking about property losses. It could be something like a bank has to have an armed guard or a 24-hour security guard. So insurance companies do put in place some requirements if we want them to write our policy. Another approach could be that they'll offer incentives to try to get you to do these things they want you to do. So just discounts for having a security system in your house.
Okay, yes, so and that's an important way that they can require or help encourage customers to have lower losses.
Right.
Insurance can also sort of, in some ways, substitute for regulation, because if we're concerned about truck drivers not having proper training, we might say, like, okay, we have to have a license for commercial drivers, and then say truck driver companies can only hire licensed truck drivers. But insurers might have an incentive to do something similar on their own, right?
Right, and so insurance companies will impose certain standards of competence, for example, or they will limit the scope of who is going to be covered under this policy. And then as a result, that encourages businesses to be aware of who they're hiring or who is covered versus who is not covered based on the insurance contract.
So if we didn't have licensing standards for physicians, I mean, if a doctor or a hospital was going to have malpractice insurance, an insurance company would have to provide some standards. They wouldn't simply underwrite anybody there, right?
Right. So as it stands now, insurance can kind of write their contracts parallel to what the state laws are. But if those, in the absence of those state laws, then absolutely insurance companies would then impose their own requirements for what physicians had to do in order to be covered.
Well, it turns out that insurance companies can play a lot of really important roles in our society, both helping out those who are hurt and then also encouraging safety. Well, thanks very much for coming on and talk about this.
Thank you for having me.
And thanks for joining us. Join us again next time for another EconVersations.